So explain Forex to me.
Okay. So Forex it stands for foreign exchange. It's one of the largest, it is the largest currently market out there. So it's where you're exchanging one currency for another. So people do it all the time. If you're traveling from one country to another, if I have the dollar and I go to, Europe or England, then I'm going to exchange my dollar for the pound.
For sure.
All right. And so you have the ability to make money on the differences that happen in those fluctuations, because I might have a dollar and they might laugh at my dollar over there because their pound is worth way more than my dollar. But while I'm gone and I come back, if the dollar fluctuated at all in price, I can make money on that fluctuation price. That's what it basically means. But, as a trader, we're just looking at price changes, price differences in the market, and we make money on if the markets are going up or down.
Got you. But how do you know if the market is going up or down? Hold on, I know this. Are you a technical trader or a fundamental trader?
I'm both, actually. I am a technical trading school. We definitely talk about fundamentals. And I think it depends on the market.
Now explain technical and fundamental.
Okay, that's
because I don't know how to explain it. I just know how to say it.
Okay. Yeah, I see you're using the terms that you...
Hey, man. I'm cultured. I know what's going on.
All right. So technical is... Most people would like technical because most people don't have that much time. And you learn enough of the skills, you're learning, the vocabulary, you're learning all of how the market's moving. You're basically learning how to read charts. If the market's going up or it's going down, you're really just looking at charts. You don't have to look at any information, any news source, anything that's going on in the world. You can just look right at the charts and you're looking for patterns in the market. And it's easier, it's quicker, it's the fastest way to kind of get into trading. But then I'd say eventually over time, you're going to want to learn fundamentals. Fundamentals, I think it's really big. It's big for a lot of traders in Forex. It's big. It's not as big for me. When I go over to crypto, fundamentals is much bigger. It's more important to know what's going on in like the economy, what's happening, what laws are happening, what's their currency doing, what are the types of regulations, what's interest rates, all these things that, can be really interesting for some and not for others. But I think it's important to know what's happening within the market, within the economy. Does that make sense?
Yeah. And how do you do that research on what channels are you watching, or how are you researching?
So, in Forex, I'll be honest, it's probably the easiest market to do it.
Really?
Yeah, I think so, because it's been around the longest. It's the most. It's been around the longest. These currency pairs have been around for a long time. So there's all kinds of places you can go. You can go to Daily FX. You can go to what is that? What's that one? I forgot what it's called. There's different places where you can go where they're constantly just giving you news on each economy all the time. It's not that simple when you want to go to crypto. You kind of have to know what you're looking for, know who go to that website, look and do more research. It's closer to stocks. But I think Forex is a lot easier.
And fundamental analysis is pretty much balance sheets, all the, the paperwork and all that behind the company as far as seeing whether it's profitable. And then technical analysis is price chart reading, candlesticks, trends, support and resistance, all that.
I don't know what all that means.
Okay, so support is your floor and resistance is your ceiling, right?
So you're looking at one of those charts that people post on Instagram, right? That's how I see it, like the little charts with the stuff going up and down.
Right.
It's like reds and greens and all that kind of stuff.
Right.
So floor is like a number, I'm guessing?
So support will be your floor. So just how you was building a house, you would have support beams. So support would definitely be your floor as far as option trading, right? So basically, I'm looking for bounces of support. And if it breaks, that's called a breakdown. And then resistance is your ceiling.
What do you mean when it breaks?
So if prices break below support, that's called a breakdown.
Oh, so support might be, let's just say for nice round numbers, $1. And this chart never goes below $1. That's
exactly.
the support.
Exactly. So let's just say it's $1 on the floor, right? And then it keeps bouncing at the dollar mark. If it breaks below that line, which is your support line,
it goes to 94 cents.
Exactly. We would buy what is called puts in options, which bets on the stock to go down.
But why would you bet if that's the first time it's going down?
Because it broke support. So
and anytime a stock breaks support, it's always going to, not always, but it's going to keep going down.
Now there's things called false breakouts. So basically what we're looking for in trading is we're looking for breaks of support or breaks of resistance, means the stock going up. So let's just say,
hold on. Yo, because this is crazy because I'm learning this stuff right now. This is good. So resistance is the highest that it goes.
Exactly.
Like, let's say the highest it's ever been is $2.
So let's just say this is resistance, the top of my hand, right? And then there's a trend, right? And it keeps bouncing on resistance, right? All we're doing is waiting for it to break that price point, resistance point, and you'll be able to see it. It'll be like a flat line. It could be all types of ways, but what we're waiting for is a break of resistance. And once it breaks that point, that's when we buy.
We make money off of the average person's emotions. So we're trading the emotion, and that's what shows up on the chart.
Explain that.
So, like I said, when LaToya shows, when you see the chop right there, that's like a sideways movement. That means that imagine you buying something, say at $5. It shoots up to $6, right? You don't get out, then it drops down to $4. Like, oh man, it shoots back up to $6. You buy it at $6. It drops back to $4, and you sell it again at $4, right? We can see that the market is manipulating, have algorithms, right? Then also we can see when it breaks past 6 and starts going 6, 7, and starts increasing in volume, right? Then that's our signal that we're going to follow the big boys and girls, the hedge funds, boom, because now the emotion turned to a green, euphoric emotion. But once it gets to a certain level, right, we can visually see that it's exhausted, it's tired, like a run in a race, and the hedge fund's about to dump it real quick. Now we know to get out. But the emotion size, people come in too late, then now it dumps, things like that. So our job is now to flip that position and make money as the stock goes lower, because we short sell a lot too.
Gotcha. So if you see it trending up, you buy when you see it trending up, and when you maybe feel like it's going to come down?
Well, you'll visually see because the emotion, right? You'll start seeing the candles turn another color, red. It hits maybe what we call a resistance area, like a ceiling, and it starts changing, it starts dipping a little bit lower, right? As a trader, we're trading for income. So we're just looking for that initial move. Once it starts coming back down, it starts changing that personality, that attitude, right? And it's like, it's no longer happy, euphoric. It's starting to turn a little fear, a little scarcity, scariness. And that's when you start exiting out the position. But a lot of people can't visually see that because of that thought process in their mind. They start talking about, oh, this is a great CEO. This is a great company. Yeah, it could be all good, right? But if you see something different, you might go against it. It's just like being street smarts, right? You could be in a great neighborhood, right? You see some undesirable people in the corner hanging there, and you got a nice car, right? Like the chances for you to drive past and it's a little bit suspect, you may want to go around. Yeah. But you're using your eyes, your sense of judgment versus it's a great neighborhood. So that's what we do. We're trading the probabilities, what we see. Like that.
Your biggest day was 14,000. How did you make the 14,000? Because to my understanding, to be able to make a certain amount of money, you have to put up a certain amount of money.
Yes. So crazy thing is this was actually an option, not an option play, but it was a earnings play. Okay, so every quarter, every company has to report their earnings. So Netflix, for example, I'm always down on Netflix, right? But Netflix reported their earnings, and the stock dropped straight down, and it stayed down. So at 3:59 p.m., the market closes at 4 p.m. At 3:59 p.m., I purchased like $2,000-$3,000 of puts on Netflix. Soon as 401, 402 came, they reported their earnings. Their earnings were bad. They missed their earnings. The stock price, boom, dropped down.
Again.
Dropped straight
down.
Hold
on. You're saying the stock price, okay, so hold on. Before Netflix posted their earnings, you're saying they're up a certain amount.
Let's say they're at $400 random. Let's say $400.
Right. And you knew it was going down.
No, I didn't. An earnings play is a guess. There's no strategy. There's no type of technical analysis you can do. You're literally saying they're either going to hit or they're going to miss. I said they were going to miss, right? And I put like $2,000-$3,000 on it. Okay, so I got in at $359 while the stock price is around $400, hypothetically speaking. At 401, 402, the stock, they released their earnings, they missed their earnings. The stock price went from 400, maybe like 325, and just boom, dropped down.
So you guessed.
It's a strictly guess, an earnings play.
You don't teach people to do that though, right?
I teach people to take earnings play every time. This is why I teach people.
You might as well just go to Vegas then if you're doing it like that.
Think about this. Our earnings play come around once a quarter. Okay? Think about if you're working a job, right? If you're working a job and all quarter you've been grinding out, making money, right? And say you hypothetically you made $10,000 that quarter at your job. Would you be willing to risk $300 of the $10,000 you made on an earnings play?
I don't understand.
All right. So say, for example, you work in your job, $10,000 that you put in your pocket that you made. And your boss come around and say, hey, everybody, you can put $300 in this pot. You can potentially make $2,000. Would you say, I'm willing to put in $300? I've already made $10,000, but I'm willing to put in $300 to possibly make $2,000.
Of course, I would do that.
That's what an earnings play is, because you've grinded all quarter. You've made money all quarter trading stock options. Now you get to the point where, hey, earnings coming up for Netflix, put $200-$300 in, you can potentially make $2,000-$3,000, $1,000, whatever it goes to, right? Or you may lose your $300. Is it worth the risk?
Okay. Okay.
It's not an everyday play. It's a once a quarter play. So it happens 4 times a year.
Right. But where's the strategy in knowing if it's going to go up or down?
There's no strategy in it. I mean, you can look and read some articles about how Netflix has been performing throughout the quarter, things of that nature. But this earnings play, and this is simply something that you do, like when you say, okay, I'm gonna shoot a half court shot at with 2 seconds left in halftime, before halftime, right? It's a simple, you either win or you don't. So it's not no.
So there's no strategy, but it allows you to low risk,
high reward. There you go. And it's like you've grinded all quarter. Put a couple dollars of your winnings into it and see what happens.
I see what you're saying. So this is for the people that are actually making money in the market. You put a couple dollars to the side. You had $2,000. We're like, yo, if I lose it, I lose it.
Exactly.
If I win it, I win it. But 14,000. When I woke up,
when I woke up the next morning. So the next morning, I woke up but the market opened at 9:30. At 9:31, that's $14,000 there.
Dang,
it was crazy.
All right, crazy. What's your biggest loss?
I lost roughly around like $10,000 in one day.
Dang, that sucks.
I lost $62,000 when I first started trading stock options. $62,000. I threw some things against the wall.
I would have cried.
And it wasn't all at one time, right? It was the whole process, right? It was a process. I would, when I first started, I started with $1,200. I turned that $1,200 into $4,000 in 3 weeks. 3 to 5 days later, that $4,000 turned into $500. I'm like, holy crap, what just happened? Because I didn't know what I was doing at all. Somebody just set my screen up for me. They threw me in the ocean. They told me to go swim. And that's what I did. And at the end of it, that time winning some, losing some, $62,000 I lost.
So not $62,000 in a day.
No, over the course of time.
I got
While I was trying to learn this process,
I got
$62,000 because I would win some, but like I may win $400 or $500, right? But then I'm losing like, oh crap, I lost $1,000. I lost $1,500. Oh, the next day I may win $500, but my losses were more than my wins, and I had to figure it out.
I knew that I could study anything because that's how I was able to get in the Army, by studying and whatnot. I joined when I was 18, back in 2014. So basically, I just knew that all I had to do was just apply effort to this, and then I'll learn it one day. Because I self-taught myself how to barber. So that gave me the self-confidence to self-teach myself stocks. Because I literally went on YouTube, learned how to barber, and now I'm making $3,000 a month. So I'm like, okay, I can just go on YouTube and read books and learn the stock market the same way. And I ended up doing it.
Really? So, okay. All right. So I'm trying to, I want to get into, I'm into stocks, and I don't have a huge portfolio. Consider it's a cool size, but I don't know really when my friend tells me to invest in something, I just do that. Right. But how do I start to research? Because I realized that there were two types of investors. Some invest strictly based on the chart. They're not looking at the company, the books, nothing like that, which I thought was weird to me.
Right.
I'm like, yo, you're just trusting the trend to keep being the trend, which it just doesn't make sense. And then you have the other, which is fundamental.
Yes.
Fundamental, where they're looking at the performance of the company.
Mm-hmm.
But you do both.
Yes.
Which one should I do?
I believe.
What should I learn?
If you have time to watch the stocks from 9:30 to about 11, then you can watch it then you can trade. That kind of distracted me just now. Okay. But anyway, yeah. So basically, to answer your question, you should honestly try long-term investing if you don't have time to watch the charts. If you have time to watch the charts from 9:30 to 11, then you should be trading, in my opinion.
So you always were like a reader, studier, researcher? Always?
Yes, I actually did good in high school. It's just I couldn't afford to go to college.
This thing what people don't realize with trading is all about risk management.
Okay.
So let me just give you a simple example.
Okay.
Imagine placing 3 trades a week, right? We call them like microwave trades. So you sit back in your computer every Monday, you got a predefined risk and a predefined reward.
Okay.
That means you know how much you're going to lose, you know how much you're going to make. You always have to have that.
You don't know, you're saying...
No, based upon a trade setup. If I get in this trade and I visually see a chart setup, I'm anticipating it to move to a certain level, right? But if it goes to this level, I'm going to get out the trade.
I see.
So, simple math. 3-to-1 risk reward. Let's risk $50, right? To make $150. So I take trade 1, right? Say I buy stock for $10, buy 100 shares. It drops to $9.50. I get out the trade. So I lost $50.
Yep.
Boom. Trade 2. I take the same trade, right? It goes against me, 50 cents. I lose another $50. So I'm down 100 for the week. The last trade goes in my favor, right? Boom. I get the 1 to 3 risk reward. So I risk 50, I made 150. So at the end of the week, I still made $50.
Oh.
Because it offset that.
So you take the formula and based on, I'm sure, what you're teaching people, you give them the formula that more times than not, this is going to work.
Correct. And if it doesn't work, you know your predetermined risk. Now, imagine you taking that and doing 500 to 1,500, 1,000 to 3,000. But if you got a systematic plan, you don't have to watch the market every day, right? But the problem is with people, they don't have risk and they don't have a reward. So if you in a trade, you up, say, 2,000. But now, what? Maybe I could get 3.
Oh, yeah.
I get 4.
Greedy.
But you knew you was only supposed to get 2.
For sure.
Because it's controlled trading.
And that's where my emotions show up.
But if you just had a simple formula like that, and we teach hundreds of people to do that, right? Because now you're consistently profitable. Most people lose on trades because they need everyone to be the lotto trade, or they let it go all the way down and they lose a lot. I just gave you a simple formula, like a 1 to 3, and we get people doing that every single day. Because now, yeah, you may get out at 2,000 and it may give you 4 or 5. But guess what? We showed you how to do it all the time.
Every day.
Every day.
And you're consistent. So
you're consistent.
Yeah.
Where'd you get the idea to trade live? Because it's kind of risky when you're talking about like this digital age of marketing and branding and personal.
Right.
Where'd you get that from?
Just being transparent, honestly. It wasn't like a decision. Yeah. It was really like, okay, I'm trading right now. Everybody, you guys want to trade with me? Like, come on, let's trade together. So it's not anything. It's not I'm doing it to say, hey, I want everybody to see, and then everybody's like, oh, what's going on? If I lose $5,000, I always tell people, I say, y'all, if I lose, my computer's not going to accidentally shut off, right? It's not going to accidentally shut off. If I'm losing $5,000, you're going to sit here and see me losing 5,000, you're gonna see my emotions. You're gonna see if I say, hold on, y'all, and go throw something in the corner. Like, you're gonna see all of that stuff.
Really?
This is real life. In real life, you win and you lose, right? But the main thing is, over the course of time, by watching me trade live, you're gonna see that I'm winning more than I lose, right? You're gonna see when I made $1,000 and the next day I come back and lose 1,500, I beat myself up. I'm like, Chris, that had to be the dumbest thing ever. You're smarter than that, right? Understanding those things, because that's the same thing that people are going to go through when they go through stage 3, New Edition, Can You Stand the Rain? Why not show it to them?
A lot of students that I've taught over the years, they needed help. And the reason why they needed help is so many people come in and they just trade everything. They're just out here, they just need to commit. So
this teaches me what to, tells me what would my preference of trading be? What would be best for you to trade? So in this situation, this is going to teach you what currency pairs would be best for the type of person that you are. And when I looked at yours, it doesn't show you as risk adverse. You're not like I could tell. I'm not, but I am. Yeah. Yeah. It's almost like if it's something that I'm for sure, for instance, I am so positive that this podcast will, I'm going to have a, long future in podcasting. Yeah, I'm positive about that. I'm putting all my money in it. Okay. Right. I'm building a building for it, everything. If I trust the person, I'm not just I'm more afraid of missing out. Right. Than not making money. So I don't just jump into everything, but once I'm in, I'm in. Okay. So you said you're more afraid of missing out? Yeah. Okay. Yeah, I don't want to. I would be pissed. Now that I know this, I'd be pissed if Jovan took your course and I decided not to. Right. And now he's making $5,000 a day. I'd be pissed. See, now, not because I'm a hater, but maybe that does make me a hater a little bit. Right? Yeah, that sounds a little haterish. A little hater? Just okay. That's just who I am. Mm-hmm. Accept me as I am. You basically kind of touched on something, that fear of missing out that you had. Yeah. Well, the good news is, even if he took my course and was making lots of money, as he should, you could still sign up at any time. And that time can come for you as well. That's cool. There's always, we teach that in trading, there's always another trade, Right. But I say that to say that is my risk level. Okay. I will risk. You'll risk if you are really sure. If I'm really sure. Okay. Yeah, for sure. So then that would make you not as risk adverse, because you can't be sure all the time. You have to kind of go with what you know and the possibilities, the probabilities. And if that's not good enough for you, you're not really that risk. You're more risk adverse. So would I be a bad trader? No, you wouldn't be a bad trader. You just would trade safer, and you would probably want to trade pairs that are not as aggressive, that don't give you that time to just kind of move around. Like, you probably wouldn't want to trade things like, Bitcoin or gold. You probably shouldn't be trading gold, because gold has some crazy fluctuations. So what all does this tell you? Maybe not about me, but about people in general. What it tells me about people in general is, if it takes you a little while to get comfortable with a certain pair, you got to be able to kind of think things through. You don't want to just jump into the market and start trading the fastest moving thing. I did that. That's how I lost $50,000, because I got into something, and there's a couple of reasons why I lost $50,000, but one is I got into something that was moving crazy amounts. Like, in the market, we call the market moves, and we call these pips as far as in Forex. So you get paid based off the number of pips that you collect. And depending on what you're trading, if you're trading and, it's $1 for every pip, then you're going to get paid $1 for every pip. You can get $100 for every pip. I was trading, a little heavier, for not knowing enough about the market. And this market in particular was known to move at least 1,000 pips in a minute. A minute. Yeah. Man, that sounds scary. Yeah. It was Ripple. It wasn't a Forex pair. I still have trouble with Ripple to this day. I have PTSD. I call it cripple, Because it moves so fast. Yes. I was doing so good in this market. And then in 1 minute, there was a spike in the market where the market dropped 1,000 pips and it popped back up.
another 1,000 pips.
Is that a bad thing?
Yes, it's really bad.
Why
That's
is that
bad.
bad?
It's bad if you're not trading in that direction. So if you're trading, if you're expecting the market to move up and it goes down, you're losing. Or the other way around. If you're expecting the market to go down and it goes up, then you're losing because you're making bets on the market, whether it's going to go up. If it goes up and you were expecting it to go up, then you get paid.
And that's the basic premise of trading Forex.
That's the basic premise. It's
I think it's going to go up. If it goes up, I win. If it doesn't, I lose.
I mean, that's a much more, that's a very easy way of saying it. Yeah, very broad. Yeah, exactly. I mean, it's more, that sounds more gambly, a little gamblier, if you.
That's so crazy because I'm glad you said that because I was just thinking, if that's it, I'm just going to just bet. I think that's going down.
I felt the gamble coming.
Yeah. I'm a gambler.
Yeah.
I was a well-rounded barber, so I cut white people hair, Asians, everybody, because we was in the Army. And you know what I'm saying? It was better for them to get their hair cut by me so they can enjoy their free time, play their video games, or they can spend literally an hour getting their hair cut. And in the Army, our time was valuable. So I made a lot of money cutting hair. So I would overhear conversations, and it was the white soldiers. They were talking about it. And then it was the nerds. They were talking about it. You know what I'm saying? I was like, you know what? I think I should do that one day. And then I would just be asking them questions like, what's going on with this, and that? And then one guy ended up, as soon as I got to AIT, he was like, I want to put you in this program that's teaching trading. He said, it's free. It was a Zoom meeting. Actually, I just got back. I just got to Fort Stewart, Georgia. And I go to this Zoom meeting, and it was these teenage guys just teaching candlesticks and everything, right? And I was only like 19 years old.
Candlesticks is, don't tell me. That's the technical analysis.
Yep.
Okay, gotcha.
So I attended this webinar when I was like 19 years old, learning about that, how they make money. So I'm like, okay, I think I could do this one day. So then literally when I turned 20, I end up just researching it, out of nowhere, because I saved a lot of money cutting hair. I saved up about $10,000 or whatnot. But, so I was skeptical at first. I was just researching. All I did was Google it, how to make money from a cell phone.
Right.
And then I just keep seeing the stock market. So I was like, I'm going to just hop into it.
Gotcha.
So I'm like, you know what? I literally spent, because I learned how to cut hair when I was 18 years old. That's when I started making money. So I literally went on YouTube and got good with it, I would say, in about 3 months.
I like what was that movie where like the kid, whatever he learned, he just can do it. He cannot, y'all know what I'm talking about? It was y'all don't watch good movies, or it wasn't really a movie. Maybe I just saw it somewhere. But it's like Neo on the Matrix. Like you can download some information and automatically know how to do karate, stuff like that.
That's
my brain doesn't work like that. You're gifted.
I feel like I could learn how to do anything. What I learned about life is if you try your best and you apply, like just give it your all. Because this is what taught me to give my all for the rest of my life. I never told anyone this story, by the way. It was senior year of track. I was running track. We was in Kansas. So I spent my senior year of high school in Kansas. So I literally grew up in Atlanta my whole life. And then my stepfather joins the military my 11th grade year. And then we ended up moving to Kansas when he got out of basic training or whatnot. So this is a culture shock for me. I'm from Atlanta. It's all black. It's probably 5 white people in my school. I moved to Kansas. It's an all-white school. So I'm sitting by myself at lunch for the first 2 months. I know for the first month because it's all white. I just came from an all-black school. But if I didn't move to Kansas, I wouldn't be where I am today.
Why?
Because it changed. It forced me to open up my mind. I didn't realize how closed-minded I was living in Atlanta. Like, even though this is a big city, it's open, you sit back and realize a lot of people don't leave here. They do. They just go to the clubs around Atlanta. And I realized, like, when I moved to Kansas and being around a different environment, especially just being around at a predominantly white school, that it was more to life. And you know what I'm saying? I learned what generational wealth was. Because when I was in Atlanta, we all rode the bus. I moved to Kansas, they all drive to school. You know what I mean? So it was
different experience.
Different.
And especially if you never see it,
you
don't even be thinking it's possible.
Their school lunch is better. The curriculum was harder. I'm just looking at all this. You know what I'm saying? I'm looking at it, especially the moment when I had to go to the Army. I'm sitting back looking, all the white kids, all the black kids too. You know, I'm from Atlanta, so I don't count.
Yeah.
Going to college. Their parents got money for them to go to school, drive cars. And I'm working at McDonald's at the time. So I'm serving the kids, the rich white kids in my school. You know what I mean? Like they coming. And I'm just sitting here like, dang, not only did your parents give you a car, but they gave you money to buy food too.
It's different.
So I'm just looking, I gotta work for everything I have. So it just made me hungry because I'm like, I'm smart too. I could go to college, but I can't afford it. I'm doing what is called giving stuff extrinsic values. So extrinsic value is almost like if you were to go to Walmart and you're trying to buy a Snicker bar, but the price is $125, but you know the price is gonna be $1 if you wait 2 months for the next season.
Yeah.
So what a lot of people like to do with fundamental analysis is give things called extrinsic values. And they have a whole bunch of ways to calculate it, but they'll give it a price and they'll literally wait for it. So they'll either say, I'm going to short the stock because it's too high, or I'm going to buy it because it's at a discount.
What does shorter stock mean?
So short means wanting it to go down. And longing something means wanting it to go up. So
Gotcha.
Longing is, so here are the bullish things you will hear in stocks. So you will hear what is called bullish and bearish. So it's based off the animal's fighting attack style. So bull strike up, bear strike down.
Really?
Yes.
I didn't know that. Did you know that, Joe? I had no idea.
So whenever you hear the term bullish and bearish, remember, bull strike up, bear strike down. So a bear just stand up, strike down. A bull go, strikes up.
Got
You know what I mean? So
bull market and bear market makes sense. Bull market means everything's up. That's what everybody's excited.
So that's what we're currently in.
All right.
But
bull market?
Yes.
I thought we just sleep. I thought we was in bear.
Nah.
No?
So we're in bull. So the market is based on what is called SPY, the S&P 500, Standard & Poor's 500.
Okay.
You ever heard of that?
No.
I
heard of S&P 500.
What about NASDAQ? You be seeing that? Yeah.
Yep.
So the S&P 500 and NASDAQ pretty much are the markets. And when those are up, that means the whole entire market is following those.
Come up a little bit to the mic.
Okay.
Go ahead. I'm sorry. Go ahead.
So when those are up, the entire market is following the S&P 500 and NASDAQ. And they have a lot of the same stocks.
The stock is real high. So if I bet that it's going to go low, I'll make money?
Listen, let me tell you this, though. That was my strategy when I first started. You remember when I said I took that 4,000 to 500, lost with that 4,000 to 500?
Right.
I was literally saying every time the stock went high, I was buying, I'm going to buy a put so the market can go down.
That makes sense though, don't it?
It does make sense, but it doesn't work. It does not work. It does not work.
Oh, wow. Okay. So
now, if you want, say for example, you want to buy something, right? So let's go buy something. We can go to options. See options right there?
So options at the top.
And then this is called your option chain.
Okay.
Now, hypothetically,
get the mic too.
Oh, sorry. This is called your option chain. So I say hypothetically speaking, you wanted to buy this particular contract right there. Click on the one that says X 0.86.
Right. X 0.86.
Yep, right there.
Okay.
The blue.
0.86, okay.
Now, say if you wanted to buy 10 contracts, that's going to cost you $866.
Okay.
So hit review at the top.
Hit review. Okay.
And then hit send at the bottom.
Send.
Yep. And then you have to wait for it to allow you to get into the trade. And right now you may be on a delay, so it may take longer. But if you want to see if you're in that trade, you can go to positions and look right there. So now you're in the trade and you see where it says P&L day and it's red in parentheses.
Yeah.
That means you're down. When it goes into green, that means you're up.
Did I bet that it's going down or up?
You bought a call. A call is when you bet that the stock is going to go up.
Why would I bet it's going to go up when it's already up?
We just playing around with it though. Like we just gonna get your feet wet.
I still look at this as my real money. Okay, now I'm only down $85, $55. Okay, so it just keeps changing.
See how it's changing? Yep.
This is some scary stuff, bro.
No, I call them trade attacks. Like when I used to be in trades, say if I got some thousands of dollars in trades, I used to call them trade attacks because your heart and your emotions just everywhere. And when you first start starting off, that's why I tell people to start off with a low amount of money because you need to understand that this is an emotional thing. Like your heart is gonna be beating out.
How do you know when something's going into a bull market or a bear market?
So
or coming out?
That's when you have to watch the charts. There is no way fundamentally you will know that the market is up without looking at the chart.
Mm-hmm.
You know what I mean? So that's one thing I will say. There's no fundamental trader that can't look at the chart because you have to know where you're buying. You know what I mean? You have to use both. You got to know if I'm researching this company, is it a good entry point? Because just because Apple was a good company doesn't mean you need to invest in it right now. You know what I mean?
An entry point is wherever the stock is at right now.
Exactly. So you always want to buy stocks on a dip or during turmoil. So the real slogan is buy when others are fearful, sell when they are greedy. So you want to buy when there's a market crash because everyone is scared. That's when you need to buy. See, people have it opposite. They want to buy when everyone is talking about it. You want to buy when everyone is scared and saying, I want to pull out, I'm afraid. That's when you buy.
That's when you buy. Do you do crypto as well?
Yes, I do. And you see what I'm saying? It's the same exact philosophy. You buy when others are fearful and you sell when everyone's greedy. So whenever you see the rappers talking about it's time for me to invest, that's when you need to sell. You see I'm keeping it 100. Like, seriously, you see what Meek Mill say.
So as Meek start talking about, let's get out of this.
It's time to, because that means culture has caught on to it. So that's when everyone is greedy. You see what I'm saying?
Wow.
Yeah. So that's literally
Is that what happened? Oh, so he tweeted, because we were in crypto, it was down.
Right.
Scarily down. Like, I lost, it was literally like half my portfolio.
But that's because
we back up, but
yeah, you gotta buy. Don't ever buy when people say buy. You buy when people like, this looks bad. You know what I mean?
If you don't want to just stay in Forex, it's important to know about these people and what they did and why it matters, because this will allow you to take these skill sets into stocks, into anything.
Okay, explain this technical. Explain what they found, especially my man Dow Jones.
Okay, so
who's Jones then? If that's Charles Dow.
Yeah, Charles Dow. So Jones was his partner, basically.
Okay, gotcha.
So yeah, but Charles Dow, he's the American father of technical analysis.
Really?
Yeah, but there was another one though. You know, his name, I never can say it.
Was it a black man and he stole it?
No, it wasn't black.
The black man, Charles Dow, stole it out to Dow Jones. Was Jones black?
No, he wasn't black.
See how woke I got just then?
You did get woke. Yeah, I mean, they did, kind of whitewash a little bit, but he was actually Japanese. So if
guy,
no, not Dow. Let me see.
Homamona.
Yeah, you got it. Go ahead and say his name. You was doing a great job.
Munihisa.
Yeah, you got it. Mm-hmm. Listen, I don't know how to say his name either, but I felt like he was.
So tell me what you learned from these people. Like, tell me a little bit about these people.
Well, Charles Dow, he was one of the, like I said, the American founder of technical analysis. He basically saw that there's different patterns in how the market moves. There's different cycles. So there's different phases of the market. And honestly, that's kind of like my favorite part. Rather than getting all the way into like pips and, candlesticks and all of that, it's important for people to know the cycles of how the market moves. They need to know. And that's kind of actually, Wyckoff he's like my favorite one. He kind of talks about the different cycles. He took what Charles Dow did and kind of made it a little more, user-friendly, and he was a teacher too. But basically, there's a phase where the market's not really doing anything, or it looks like it's not doing anything, and that's called the accumulation phase. And in that accumulation phase, most people are losing. Most people have like really poor, ideas or attitudes towards whatever. Like things are bad in the accumulation phase. All the news, if you're looking at the news surrounding the currency, if you're looking at the news surrounding whether it's currency, crypto, the news is bad. But what's happening is the market participants, the big players, they're buying it up because people like us are like, oh, this stuff is crap. This stuff will never go anywhere. I remember when Bitcoin, before it went on its last huge run, if you would just ask anybody about Bitcoin, oh, that's the dark money. I'm like, like, okay, the US dollar is not.
Right.
Okay, you know, like, I mean, that money, they it's a scam, it's this, it's that. Like, they didn't think, you know, people had bad experiences because they invested in it before, it didn't do well for them. So accumulation phase is like, people have, it's just a negative phase.
Right.
But that's the time where you should be buying. We don't think that way though. It's like there's a lot of panic going on. When you see panic, you should be excited as an investor.
I've been hearing, okay, so I've been hearing that trading is all emotion.
Not all emotion, but it is emotional. It is emotional.
So where do we come in with people that they say, yo, they get, where their emotions have caused them to make a mistake?
Oh yeah, I've done it plenty of times. So for example, one week I used to trade Amazon all the time. So all week I've been busting Amazon in the head, right? I've been playing the bounce strategy all week, bounce strategy.
What does that mean?
So basically when the stock is going down and it comes to this strong level of support, support is like this floor right here, right? If I throw something at this floor right here, that means something's gonna bounce off of it and we can't fall through it, okay? So that's the support level. And I will play it off a strong level of support. It bounces off support, goes up, I make $1,000, $2,000. So I'm up like $12,000 for the week. Okay, come Friday, right? I'm playing the same strategy, but it broke through the floor this time. So I should have gotten out, but I told myself, now not the market, I told the market is going back up. The market said, no, Chris, we're going down. I said, no, you're going up. The market said, no, Chris, we're really going down. The market went down. I lost $10,000. I was up $12,000 for the week, lost $10,000 on that Friday.
So the emotional part says, I'm just hoping I'm going from strategy to
hope.
Hope.
There you go. This side of your shoulder is the person saying, get out, get out, get out. This person like, nah, Chris, stay in. And it's like a battle. It's really like a battle.
So it's about like cutting your losses.
Cutting your losses.
How much would you have lost if you'd have stopped when you knew you should have stopped?
Oh, I had met the broke even. The moment I knew I should have got out, I would have probably been broke like $100, $200, $200, $300 down. That's about it. Break even. I literally saw it happen, right? And it formed this thing called an H pattern. Like the market falls down and then it bounces and come back up. And remember, I said I was playing the bounce strategy. So we bounced and it was coming back up. Then it hit the top of an H, like boom, like an H forming. Then it stopped. And it couldn't break through. And I saw it starting to fall down. And I'm like, Chris, and I'm trading live at this time. I'm like everybody in my Discord chat. We just broke the 1 year, 1 day trend line. You probably want to sell and get out, right? But I stayed in. I'm telling everybody to sell, but I stayed in. I'm seeing it. And I'm watching it. And now it's going down. And now I'm literally telling myself, Chris, get out. But I said, I'm gonna wait till it come back down to that where that H started at, where it bounced and came up. I'm gonna let it come back down and see if it bounced again. It broke through that. I said, Chris, get out. I stayed in. It's like, it's
Are you saying this on live? Like, yo,
I'm talking, like I talk to myself all the time when I'm trading. You hear people's like, he's just talking to himself, y'all, don't worry about it, right? And so I'm saying all this like, Chris, get out. But I'm telling everybody else, y'all should get out. And I'm telling myself, get out, but I'm staying in.
But I'm saying, are you saying this live? Like, Chris, I need to get out. Get out.
Oh yeah,
get out. And you're just and you're staying in there and you're telling them like, yo, y'all should get out
and
right now.
See it, and they see my account balance going down to 2,000, 3,000, 4,000. They're watching it happen. Because like I said, I'm not gonna let my computer just happen to turn off when I'm starting to lose. I'm gonna let you guys see the meltdown, and that's what it was, a meltdown.
It was a meltdown. Why couldn't you get out?
It's the hardest thing to do. The hardest thing to do is to sell when you think that you are right. That's why you should always set a stop loss when you trade. Always set a stop loss.
You didn't set the stop loss.
I didn't set a stop loss.
Why not? You forgot, or just out of arrogance?
I didn't want to. I didn't want to.
You think you're that good, huh?
No, I didn't think. Is the thing about it and this is people fail to realize, right? And I'd be completely honest. I tell you the truth about trading. When you go on a nice win streak, it's a great thing financially, but mentally, a loss is coming. But you've been winning for 4, 5, 6, 7 days. You feeling good about you. Like when I say the feeling of you winning this amount of money, like in November, I made like $30,000, $40,000 in the month of November trading. It's a great feeling. But then a lot of people get hurt with that next loss that comes because you've been on this win streak and you hit this loss and now you like, I can bully my way through it, and it hurts you. And I had to, and that's why I had to start to control those things. And that's why I say now, when I told you at the beginning, I don't trade with a $40,000, $50,000, $60,000 account. I'm gonna trade my $10,000 to $15,000, boom, 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 and be good because I know what's my weakness, and that's my weakness: trading with a lot of money.
So,
oh yeah,
me personally,
definitely.
you know what I mean? Like, so
I'm happy about that because it was just like a wind of relief when we started seeing other people as well in the markets that were not, the other, So it was awesome, definitely. And it still is because we highly encourage that. We want more of our people to get involved in these finances, especially, the different markets. One thing I want to piggyback on is the 25,000. So I don't want the audience to think like you can't trade because you don't have that money.
that's what I was thinking.
There's options, right? You can trade options in a cash account. You don't need 25,000.
Oh, y'all trade. You're just saying you need 25,000 for day trading.
Day trading, correct.
Only for
day trading.
Okay,
right?
I got you.
So there's times, we're shorting 5,000 shares or buying 5,000 shares of whatever stock it is. So you need that capital. So I'm just going to explain just a little bit. 25,000, you qualify for a day trading account. Your broker gives you 4-to-1 leverage.
Mm-hmm.
So your 25,000 becomes $100,000 in capital.
Well, hold on. I don't understand.
Mm-hmm.
Say it again.
If you have your 25,000, you fund your account.
Yes.
You qualify for a day trading account. Your broker gives you a 4-to-1 leverage. You now have $100,000 accessible to you in capital. Although only 25K is yours, the broker is giving you more money.
So what happens if you lose 60,000?
That's called the margin call, and you got to fund that account. So, of course, with margin accounts, there's always that risk, and that's why your education is extremely important.
Well, my question is, say, for instance, I put 25,000 in. My broker gives me 100. I'm going full tilt. Yep. And I lose the whole 100,000.
It'll be very hard for you to lose that.
Yeah, because they're going to cut you off.
They're going to cut you off.
They're going to cut you.
Yeah.
The moment your account dips under 25,000, you have to fund it. They cut you off. So let's say you're in a position and it's coming below that $25,000 capital of your money. Oh, they're cutting you off and they're hitting you with a margin call at the same time.
What's the point of giving 100,000?
So short-term trading. Yep. So the average day trader is trading like maybe 5 minutes in a trade, maybe 15 hours. So they're giving you extra leverage to purchase, right? So now, say you buy, look at all these expensive stocks, Tesla, Apple, a lot of these stocks. The average day trader is getting in at a minimum of 1,000 shares of a company, right? Because every 10 cents, you're making $100. Right. So if I can get 1,000 shares of a company, and it moves $1 or $2, I made 2,000. An educated and mature trader, depending on their income, is going to exit that trade. That profits come with them, right? So the leverage is not used normally when you're day trading to hold a big position like that to get killed. You know what I mean? But people do that.
Yeah,
they do that. They'll do like an earnings play or like a suicide type trade, like, hey, I'm gonna just go all in and see what happens. And like the next day, like Latoya said, they call it a margin call. You could lose that money. Now you owe the broker the money plus.
Gotcha. So we go, let's say I lose 35,000. I'm down 10,000. How do they collect the money?
They're coming after you for that.
Oh, so they like...
Yeah, they have all your information. They have your social. So just think when you're actually...
so I was going against your credit.
Everything. They got everything.
Okay, okay. I was
they will get their money.
Basically, the DeFi movement is moving away from the banks onto a platform that is decentralized. So blockchain, all of that is all about decentralizing. It was built for the underdog. It was built because, of all the corruption that is already going on with our current government system. And so the DeFi movement is allowing you to kind of do banking without the big guys, cutting the middleman out. And so smart contracts are a way for you to do business without having to worry about a third party making sure that, whatever was set. So for instance, DeFi it has the potential to, disenfranchise lawyers, because when you need a business deal done, you got to have a lawyer to sign off on it. But if you have a smart contract, it's a contract that will fulfill itself without the need of any lawyer, any middleman. If you're trying to do any kind of deals from a financial standpoint, if you're trying to send money right now, you need a bank, you need Visa, you need one of those to say, yep, the money's in their account, now it's in yours, everything's good, let's take our cut. You don't need that if you're decentralized. So smart contracts are huge. And that's kind of what, right now Cardano wasn't getting the play like Ethereum, because Ethereum has all of these smart contracts. Polygon is what's helping Cardano with that smart contract process. So, yeah. So Polygon, even though it's a small player, it's huge. Cardano doesn't have any smart contracts.
Gotcha.
Do your research.
You got Polygon, Johnny? Because you're not financially educated.
That's one of
you don't know what's going on.
Yeah. And I'm not an investor either. So
let's just say Apple, Amazon, Tesla, anything like that gets oversold, you always want to buy. But be careful with overbought, because stocks can sit in limbo while they're up. You see what I'm saying?
So, but real quick, oversold means they sold too many of the stock, like too many people that bought the stock?
Oversold is just saying that, okay, so in the stock market, there's buyers and then there's sellers, correct?
Yep.
So whenever you see prices shooting downward, that's because a vast majority are selling. And the majority could be people, machines, hedge funds.
Right.
All of that plays a role.
Too many people sold their stock in this one particular time period.
Yes, it's a lot of selling, but a lot of institutional selling. So if all of us in this room sell, that won't do anything. But when the billionaires and the funds and the ones who have all the shares, if they start selling, that's when the prices drop. You see what I'm saying?
And you buy at that point?
Yes.
But it seems like...
And that's when it's oversold, because the big institutions are selling. You see what I'm saying?
Would you buy at that point, though?
Yes.
Okay.
Because if Amazon and Tesla becomes oversold, yes, you want to buy the dip.
Okay, and just answer this question for me. If these major companies who have millions and millions of dollars to pay people who truly understand this stuff, if they're selling, why would I buy?
Because
they're selling it for a reason.
Right. Bad news doesn't always mean bad for the company. So how many times have we seen Apple get sued for knowingly slowing down the old iPhones? But
did they get sued for that?
Yes.
Good. I hate when they do that. As soon as a new one come out, your old one about to start acting up.
That's and they got sued for that last year. But guess what? Apple was still Apple, and they still gonna go up in the stock market. Boeing, the planes crashed. Remember those? What happens? They still go up eventually. So during turmoil, you still want to buy good companies, because the stock market, in my opinion, is meant to go up. Think about it. I just told you, do not sell as quick as you buy. See what I'm saying? So when stocks are overbought, you don't want to try to short them as quickly. Stocks, literally, they rise quicker than they fall.
Like your business is doing well, you have another idea, that business does well, you feel like you're to go, and you just start doing so much, then you're over leveraged in businesses.
Exactly.
Because you felt like you were doing well.
Exactly.
And you take that loss, and you say to yourself, yo, that'll never happen to me again. But if you go long enough on another win streak, you forget the fact that you said you'd never do that again.
Bingo. Yeah, that's true.
You know what I mean?
And that's why I tell people, it's coming. It's like it's coming, and that's why I always tell you, when I get to a certain amount, I take that money out, because if the money, that's why I started off saying what I did, because when you have that money in your account and that stock is dropping and you're down, your thought process is, I can buy in more right now, and off of this bounce, and it's going back up, I can make all that money back, because you can. But what happens if you put that money in there and that bounce doesn't bounce how you want it to bounce? Now you're losing more money faster, right? So it happens that way. And that's why you have to get the mindset, risk management. That's why we have a counselor in our program. We have a counselor come every second Thursday to talk to people and give them that understanding of why are you doing certain things you're doing? Because it's It's serious. It's really
Counselor.
Yeah. Every second Thursday, a counselor come and talk to all the traders in the program.
Golly.
Yeah.
I mean, that's how they get people in Vegas. Because you're down and it's like, yo, I lost so much and I can't go home with this loss. And you'll see these people who they're up and the worst thing that can happen is you go up.
Oh, yeah.
Because when you come down, you're like, oh, I remember the feeling beat up. I got to get back
up there, that first high.
But then you keep going down.
It's like a falling knife. You can't stop it, right? So, and that's the thing about it is, and that's why I tell people, listen, I did that. I did it. I know the feeling. I know the feeling of not being able to stop it. So that's why when you asked me what was my largest win, and I said 14,000. You may have other people on here saying they made hundreds of thousands of dollars a day or millions of dollars. But I'm telling from what I know, what I can control and what I can handle, I can't handle trading with that much money.
Yeah. How do we get that? Like, what advice would you give for people to be disciplined? Because being disciplined gets boring, and eventually you just want to.
This thing about it, I'm gonna be honest with you. Being disciplined when it comes to trading stock options does not get boring. Not stock options, right? Because you're sitting here watching your account grow. You got to think about most people when they come into the stock. Think about this. Most people when they come into the stock market, they've been doing something their entire life, right? And for me, I tried to sell vacuum cleaners. I tried to sell knives. I tried to do a lot of things, right? And none of that stuff worked for me. And I saw the stock market and I'm like, holy crap, I can make thousands of dollars a day. And what was the next thing from someone, what's the next thing somebody want to do the next time they do it? They want to make $100,000 tomorrow, right? But no, it's a process. If you think about it, took you 30 years to get to even find out about trading. If you say, I can do this for the rest of my life, if I can make $300 every single day, that's $75,000 a year. If I make $100 a day every single day, that's on average, right? That's $25,000 a year. Think about somebody working a full-time job right now. They make $50,000 a year, say, for example. What is one thing they probably say every month? If I did not have to pay my mortgage payment this month, I can get ahead. You trade stock options, you make $100 a day, your mortgage is paid every single month.
But people don't think like that, CJ.
That's the thing about it. That's why I've been through it. Yeah. So when you come to me, I'm telling you, I spend time with you and I'm telling you the real. Like, you do not have to make hundreds of thousands of dollars. Make sure your rent, light bill, gas bill, mortgage, phone bill, child daycare, if all of that is paid from trading stock options, now you're going to wake up on December 31st, 2021 and look at your account. You got $25,000, $30,000, $40,000 in your account. Some people never had that amount of money in their account a day in their life.
People don't realize that there is something called buy the rumor, sell the news. So this is what happens. A lot of people buy on the news. And whenever, so that's what I told you. Whenever you see a lot of people talking about it, that's a bad thing because they are what is called the news now. You see what I'm saying?
Yeah, that's smart.
So buying the rumor means if crypto is down and then you hear an analysis say, I believe the price will go up to this or something like that. But that's not even a rumor. Let's just say, for instance, the PS5 when it came out. I can name 2 instances where this happened. So when the PS5 came out, everyone, when Sony, you know how Sony, they have a release date event where they just show this is our new system, this and that, right? So a noob trader or a person who knows nothing will buy when that event happens.
Right.
They'll say, yo, Sony is about to release the PS5, dog. Buy their stock, it's about to go up. And then they lose money because they don't realize you're supposed to buy on the rumor.
Right.
Meaning when they say an event is going to happen on this day, you're supposed to buy way, like weeks before. You're supposed to buy when you know that the event is happening. So what people do is they push up the stock until the event happened itself, and then they sell their shares. So it's called buy on the rumor, sell on the news. So you never want to buy a stock during its significant news day. You're supposed to buy it leading up to that news day. You see what I'm saying?
Got you.
Because that's when all the hedge funds and the people are selling because they have already profited on the event.
Give me a specific scenario where you really came up off of a rumor.
A rumor, I would say Tesla, the Cybertruck. Mm-hmm. So you remember when Elon Musk first revealed the Cybertruck and he broke the window or whatnot? Mm-hmm. So I bought the rumor and I sold the day that the Cybertruck was happening. Tesla is one of the easiest.
Hold on, you bought it when they were talking about it, but when it actually comes out, you sell.
Yes.
Wow.
That's what you're supposed to do.
Wow.
But new traders think you're supposed to buy during the event day. And that's when it's going to drop.
You're never fearful that like, yo, I'm a sell it on that day, and because it's good hype, it's not gonna go up?
I don't know why it works like that. That's the way the stock market works. It drops the day that the event, that the news happens. Now, it's different for earnings. This is about news and event days. You're supposed to buy the rumor and sell the news. So that is why a lot of people lose money when like AMC was up. By the time they try to buy it, they were supposed to buy when the rumors that AMC was going to blow. You see what I'm saying?
And that's crazy because I did hear it, but I'm like, we in COVID. My own rationale.
Right.
I think, okay, we're in the middle of a pandemic.
Right.
AMC's closed. They're not making any money. But because everybody's gonna be in the house, they're gonna find a new way to enjoy themselves.
Mm-hmm.
Meaning, ain't no reason. Why do I need to go to the movie theater again?
Right.
So even after the pandemic, ain't nobody going back to the movies like that. I couldn't see it because I'm thinking everybody's gonna be nervous to be around each other. So with my amateur ability to research, I'm thinking, no, I'm not going to buy it. But then I was sick when I started looking at the stock price. I said, golly.
But that's not why it went up. It's not because it has nothing to do with, I guess you can say, personal or common sense at all. This is why AMC, GameStop, all of those exploded. It's because what happens is it was a movement created for everyone to buy shares, correct? Yep. So what happened was the people, you and I, were buying more shares than the institutions were at the time. And what happens is when they're trying to sell, they're forced to cover their share because remember I told you they the ones who got to sell for the stock to go down. So in order for GameStop, AMC, all these stocks to go down, they have to sell their shares. But if everyone is holding shares, it causes a short squeeze. So that's why they were trying to limit people from buying it because we're causing the stock to short squeeze because the institutions and the large hedge funds have to cover their shares and it forces the prices to go up because now they have to buy. You see what I'm saying? Because buyers are stepping in. So they're forced to buy because they can't sell anymore. We're buying it up.